You know what gets traders in trouble? They set targets that look great on the chart, but the move was never likely in the first place. Price might get there once in a while, but most of the time the target is either too far or the stop too wide, and the whole trade is built on hope. That is where this indicator helps. The Monte Carlo expected move distribution by LuxAlgo uses Monte Carlo simulation and geometric Brownian motion to generate hundreds of possible future paths, then builds a possibility distribution that shows where price is statistically most likely to trade over your chosen horizon. So instead of asking where will price go, it helps you ask a better question, which is where is price most likely to be? We're gonna build this on TradingView, which is the trading platform I'm gonna be using for this video. If you haven't signed up yet, there's gonna be a link in the video description for you to do that. Open GBP/JPY on the 15-minute time frame, then go to indicators and type in Monte Carlo expected move, and you wanna select this one by LuxAlgo. This tool projects a full expected move profile forward, not just a single forecast line, which is why it feels very different from most indicators. Once it loads, the main thing you'll notice is the projected distribution at the end of the forecast window. This is the heart of the tool. It shows the median outcome, the one standard deviation expected move zone, and the thinner upper and lower tail zones where outcomes are less likely. The main colored zone is the range where most simulated outcomes cluster, while the gray tails show the less likely extremes. This gives you a much more realistic map for profit targets, stop placement, and general trade expectations. You'll also see dashed projection levels for the upper expected move and the lower expected move. These matter because they give you a volatility-based boundary for the move. If price races into the upper expected move too early, it may already be stretched relative to current conditions. At the same time, if it drops into the lower expected move too fast, it may be statistically overextended to the downside. This doesn't mean that price must reverse right there, but it does tell you when chasing becomes harder to justify. Now, another important part is the distribution shape itself. The fattest area of the profile is the highest probability zone. The thinner parts are lower probability outcomes. This matters because it lets you compare your trade idea with what the model is actually saying. If your take profit sits inside the main expected move zone, that target is much more realistic. If it sits deep inside the tail, then you're asking the market to do something that is less likely inside your selected time horizon. Now, let's go through the settings. The first one is simulations. This controls how many future paths the model actually generates. More simulations usually give you a smoother and more stable distribution. Next is projection length, which decides how many bars into the future the expected move should be projected. Shorter values fit faster trades, while longer values fit longer holds. After that comes volatility lookback. This is the period used to measure historical price fluctuations before building the forward distributions. A shorter lookback reacts faster to price changes, while a longer lookback smooths things out and makes the model learn more on broader conditions. For this strategy, we're going to change the volatility lookback to 150. The reason for this is simple. We want the model to capture the longer-term behavior of price, especially since this affects how the projection leans when include trend drift is enabled. With a longer look back, the drift has a steadier base instead of reacting too much to short bursts of noise. And then we have include trend drift. When it's on, the distribution leans in the direction of the current trend. But what happens when it's off? Well, I'm glad you asked. The model assumes a more neutral path. There are also visual controls like price bins for histogram detail and width settings for how broad the distribution appears on the chart. These are my settings. You can test with different settings depending on your personal strategy, but after you've made your changes, click OK. Next comes the strategy. How do we trade with this indicator? Well, in order to trade with this indicator, we're gonna need another indicator. An easy option is to add a trend and pullback tool to the chart. Open the indicator search tab and type EMA, then select the one under technicals. Open its settings and change the length to 150. Under the smoothing type, I want you to choose SMA plus Bollinger Bands so you get a center line and the bands around it. Then go to the style tab and disable the EMA line and change the lower Bollinger Band color to red, and then click OK. Now, a moving average is a lagging price-based indicator that smooths noise, and Bollinger style bands give you a clear visual for price pullbacks and stretch. Now, the question is, how do you take a long position? Well, simple. First, you want the market to be behaving well enough that pullbacks are respected. In this strategy example, a bullish pullback is when price pulls back into the Bollinger Bands without breaking and closing below the yellow middle band. This tells you that the pullback is still controlled and the structure has not been lost. Now, after the pullback, you want a continuation signal, something like a bullish engulfing candle or another strong bullish rejection. That is going to be your price action trigger. Now, before you enter the trade, take a look at the LuxAlgo Monte Carlo projection. You want to make sure there is enough room in the median outcome zone and the projected upside zone for a take profit to make sense. In other words, this upside projection should leave you enough room to place your take profit inside the expected move, but not beyond it. At the same time, you don't want the lower tail zone to be so deep that it forces an overly wide stop loss. You can judge this quickly by eye, or you can test it with the long position tool. Now, for the take profit, you want to place it just below the top of the blue expected move zone, not all the way at the edge. You want to give it room to fill before price reaches the extreme. For the stop loss, you want to place it below the most recent swing low, but at the same time, you want to make sure it sits inside the lower gray zone comfortably, roughly 10% to 20% into that lower tail zone. That way, the stop loss is still aligned with the model's downside boundary, rather than floating randomly in the middle of the chart. The next thing you want to do is check the resulting risk-reward ratio. For this strategy, comfortable enough with something as low as 0.5R, because while testing this, I realized the stop loss was not getting hit enough to make that a problem. So here, I'm fine taking the setup even if the reward is only half the risk, as long as the structure and projection line up. Now, for a short position, you want to keep the same conditions, but flip them. The first condition is you want a bearish pullback where price pushes into the Bollinger Bands without breaking and closing above the yellow middle band. This shows the pullback is still controlled inside a bearish structure. And then you wait for a bearish continuation signal, ideally a bearish engulfing candle or another strong rejection candle. Now, before entering, you want to check the Monte Carlo distribution and make sure the downside still has enough room. You want enough space in the median outcome and lower expected move zone to justify the short position, while at the same time making sure the upper tail zone is not so far away that your stop loss becomes too wide. Now, for the take profit, you want to place it just above the bottom of the blue expected move zone on the downside, rather than trying to squeeze every last single pip out of the move. Now, the stop loss. You want to place it above the most recent swing high and make sure it still sits comfortably inside the upper gray tail zone around 10% to 20% inside of it. And then you want to check your risk-reward ratio. Just like on the long position, I'm comfortable taking a setup that comes out to around 0.5R if the structure, pullback, and Monte Carlo range all support it. Now, what makes this useful is that the Monte Carlo indicator is not trying to tell you exactly where to buy or sell. It is, however, helping you structure the trade around what is statistically reasonable. The moving average and Bollinger Bands help you identify the pullback and continuation. The Monte Carlo projection, on the other hand, helps you judge whether the remaining upside or downside is worth taking and whether your stop placement still fits the model expected range. Put those together and you stop forcing trades into unrealistic targets. Now, this is not financial advice. Use this for education only. Backtest it on any trading security that you like, forward test it with a small size, and build your own clear rules for entries, stops, and targets. The goal here is not certainty. The goal is better structure, better expectations, and better decisions. If you found value in this video, remember to leave a like. At the same time, if you want more breakdowns like this, tools that help you trade with logic, structure, and realistic expectations, consider subscribing so you don't miss the next one. Thanks for watching. See you next time.